Today, we are going to talk about ICHRAs. ICHRAs. Everyone's talking about them. So, ICHRA, ICHRA, stands for Individual Coverage Health Reimbursement Arrangements. Brokers either love them or refuse to talk about them. I don't really get the polarity, but it's there. This is a two-part series. Today, we're going to cover what an ICHRA is, where it came from, who it's right for, and why some brokers just won't pitch it to you. We also have to do a part two, which covers how implementation actually works. P.S. That's my biggest concern. And then the legal traps that nobody warns you about and what's pending in Washington that could change the whole math. So here's the fact that a lot of people don't know. And I think this is why a lot of the broker community is a little bit hesitant when it comes to ICHRAs. ICHRAs actually did not exist before 2020. So they're pretty new. The Departments of Treasury, Labor, and Human and Health Services issued a joint final rule in July of 2019. And then that rule went into effect January 1, 2020. So 6 years in, the HRA Council reports that ICHRA adoption is growing at over 30% year over year. Hundreds of thousands of employees are now covered by ICHRA arrangements. It's really one of the fastest growing alternatives to group coverage in the US market. But a lot of employers have never even heard about it, and a lot of brokers absolutely hate it. So let's get to the bottom of this. Okay, so in its simplest form, this is an ICHRA. Employer defines an allowance, a set amount, employee picks a plan, and then they get reimbursed. That's the model completely stripped down. Instead of your employer picking one health insurance or a couple of health insurance plans for everyone, your employer sets aside a fixed monthly amount of money. So for example, $500 a month for individuals, $1,200 a month for families. You, the employee, go shop for your own health insurance. Healthcare.gov should have a broker-assisted shopping tool, but ultimately you pick the plan that fits your family, your doctors, your prescription, your budget. And I like it because the plan is in your name. You keep it when you leave the job. The employer's cost is fixed, it's predictable, and then the employee gets the actual choice. So I like that part. You can start to kind of see why this model is gaining traction and sounds attractive. I think the real advantage here for employers is cost predictability. There's a set contribution, that's your cost, done. There's no mid-year renewals, no surprise rate hikes, no underwriting cycles. It's also scalable. You can adjust contributions based on class, full-time versus part-time. You can have salaried versus hourly. The IRS actually allows specific employee classifications, which means you can truly tailor the benefits to your workforce rather than buying a one-size-fits-all, which I think that's kind of cool. Also, you don't have to worry about ACA compliance. An ICHRA can satisfy the employer mandate if your contribution is structured correctly. So this means large employers can offer ICHRAs as their primary medical benefit and then still remain compliant with the ACA. And then the employees have real choice. There's no 3 carrier plans curated by your HR department. You have to pick one of them. Every individual market plan available in your area, PPO, HMO, EPO, high deductible, low deductible, it's all your call. You have network freedom. And you can find a plan that includes all of your doctors. And again, the plan is in your name. So if you were to change jobs, get fired, get laid off, the plan's going to stay with you. Free tax dollars. The employer's contribution is tax-free. Okay, so that was like the sales pitch. All of that sounds incredible. But what are the disadvantages? And I'll tell you my hesitation, my personal hesitation with ICHRAs. First of all, it is really not the right answer for every employer. There's just no way. I mean, think about the employee burden. In a group plan, employees pick from 3 options and then they move on with their lives. And even that is a lot for them sometimes because it's very, very confusing. Can you imagine an ICHRA where they actually have to shop the market? They have to evaluate networks and weigh deductibles, understand all of these metal tiers, and actually make a real decision for their family? For some workforces, this could be empowering. But for other workforces, probably for most workforces, this is extremely overwhelming. And then communication complexity. If you roll out an ICHRA, that's going to require real change management. You're not just changing a plan, you are changing the entire mental model that employees have had their entire careers when choosing health benefits. So, this is going to require a lot of education support. I do think a lot of these ICHRA partners offer a pretty robust platform. So, that is definitely something that you want to keep in mind as well. Regardless, if you skip that communication piece, you are going to have one angry workforce on day one. Network adequacy in some markets. The individual market is strong in major metro areas, Houston being one of them, but it's surprisingly thin in rural areas. So before you commit to an ICHRA, I think one of the most important parts is your broker has to confirm that there are adequate quality plan options in every single geography where your employees live. Something else to keep in mind with ICHRAs, you really lose your group purchasing power. Claims history can sometimes negotiate even better rates on a group plan than employees can find individually. So the real question here when we talk about ICHRAs is whether they fit your situation. My honest answer from seeing this every day is ICHRAs are exceptional for small or mid-sized employers where group rates are absolutely killing them. Or companies with workforces that are spread across multiple states or markets, industries with high turnover where that portability is genuinely valuable, employers who want to lock in their healthcare contribution and stop riding the annual renewal roller coaster, who really need a set fit budget, would be great for an ICHRA. Companies that are growing really fast. During that phase of rapid growth, an ICHRA might be a really good fit. But ICHRAs are not a good fit for employers with a heavy blue collar workforce, employers that have a workforce that values simplicity over choice, companies whose claims experience is genuinely better than the individual market average. Then you're going to want to use that underwriting advantage. And this one really matters. Employers who aren't willing to invest employee education and a quality enrollment platform. That's going to be everything because ICHRAs are a tool, right? It's not a magic wand, but it could be the right tool if used correctly. And it could completely transform the way some employers offer benefits, but it could also be a huge disaster. Okay, so those are my thoughts on ICHRAs. Stay tuned for part 2. And this is where we're really going to get into the implementation side, how ICHRAs actually get rolled out, any legal or tax traps that catch employers off guard, and then something really cool that's pending in Washington that could expand or restrict ICHRAs in the next 2 years. And that would be a really big deal. All right, make sure you subscribe so you don't miss part 2. Have a great week.